besides interest rates and central banks, oil is probably one of the most important determinants of market sentiment for 2016, and it may do it in an unexpected way. Oil is now down 50–60% year on year. It's declined by that much 5 times in the last 15 or 20 years. And every time, the economy has accelerated dramatically after that on a 2 to 3 year view. So if there is going to be a really positive upside surprise, economically and therefore in sentiment terms in 2016, oil may be a pleasant provider of that. Emerging markets have underperformed now for several years, not just in 2015. The worst one this year was actually Latin America. Eastern Europe was okay, Asia not bad. The oil-related, commodity-related areas were particularly weak. So if you're looking for somewhere as a contrarian with maximum negativity, Brazil and Latin America is a great place to start. Collapsing currencies, political turmoil, soft commodity prices, economies weakening. Interesting place to start. And overall for EM, they're on a very low historic multiple of book value, certainly levels that they've been down there before. So valuation-wise, you can start to make a case. Your big problem in the short term is what's going to be the catalyst that really wants people want to look at them again and get involved, and a Fed rate rise and a strong dollar might put people off, but at least a lot of the bad news is now baked into the price, I think. Valuation is one of those things, it's definitely an art, not a science, and we could argue about it all day, quite frankly. But if you look at some fundamentals like long-term market cap to GDP, the US and the UK are probably expensive. If you look at long-term earnings, the UK is probably okay, the US is expensive. If there is value, it's things like Japan, maybe a little bit of Eastern Europe, Latin America definitely. But again, as with a lot of those cases, you can have cheap stocks and good news, but not both at the same time. So you're still looking for a potential catalyst. But if there is value to be had on things like book value that don't move around as much and therefore more reliable than earnings, they're the areas that at least intuitively look interesting right now. I wish I had a crystal ball, because nobody in the end really knows what's going to happen. Even the central banks don't. If they did, they wouldn't be pussyfooting about with small interest rate increases in the UK and the US, or pushing ahead with monetary loosening in Japan and Europe right now. They don't know. So if they don't know, it's going to be pretty tricky for investors to work out. My personal suspicion is we're going to get a deflationary growth shock in the short term, which will lead to a shock and awe central bank response and lead to inflation in the long term. And obviously different asset classes will perform differently under those scenarios. The case for a balanced portfolio, boring as it sounds, has probably never been stronger.